Welcome, guys, to the fifth session now of the weekly update. We've gone completely viral now, virtual, I should say. We're now doing a Zoom interview with another guest. We've got Gary Wagner here. We're going to do a bit of a Q&A session between us three to break down the gold market and find out what really is happening with the gold bugs. And we're going to get into some chart analysis a little bit later on. But right now we've got our regular guest, Greg Rubin. How are you going, Greg?
Very well, Lucky. How are you?
Always very good. Excited to get back into the office for the next one, but for now, this virtual discussion is taking place. And our new guest, we've a familiar face on YouTube if you've seen him around, but we've got Gary Wagner from the Gold Forecast. Gary, how's it going, Greg?
It's going excellent. Very good.
Very, very nice. Gary, a 35-year career as a technical analyst. I'm sure you've seen it all. 35 years is a massive margin. Greg got about 15 under his belt, 35 years. What can you say about that to start with?
I started trading back in 1985, and we're certainly in a different world now with different environments. The most crucial difference when I started to now is going to 24-hour markets. When I started trading, they would shut down completely at a certain time. And then when it opened, if there was a big move, we had things called lock limits where it would, go limit up or limit down on the open. So that's the biggest difference. Of course, the only other difference is the highs that we've seen between when I started and where gold has been over the last couple of years. Of course, the first high, 2011 mid, and that's when we hit 1920. And then, of course, in August of 2020, when we hit 2088. Those are the biggest things that I've seen in gold.
2088, that's hard to imagine these days, but who knows? So, Gary, we're getting on to the first question. I wanted to actually just to start with break down a little bit about what you offer with the Gold Forecast. So we have a similar kind of mentorship program that Greg runs, but I'd love your like a 5-minute breakdown of just what it is that the Gold Forecast does offer.
Well, what we offer is a daily video newsletter along with an opening letter. We also give direct market calls. So for example, we entered a long position on Thursday at 1790. We send out alerts through SMS as well as through email. And then we put our initial stop in. On today's video report, I announced that we're going to trail our stops up. I tend to like that if you've got a market that is truly trending. I have a top where I think it might retrace, but I'd rather start trailing the stop up first. So we offer that. We also have a Bitcoin report that comes in, and that's done by our producer, Joseph Wagner, also my son. And that's all available on a daily basis. Okay,
excellent. So, Gary, you're the author of a book, Trading Applications of the Japanese Candlestick Charting. So I'm really interested to see some charting breakdown and some analysis from you later on. I think that'll be very insightful. But I found it interesting that yourself and Greg actually do use very similar trading methods, Fibonacci and the Elliott Wave theory, along with some other things. I'm just curious now on Greg's side of things. Over your career, a 15-year career, and then Gary, a 35-year career, you can start off with one trading method, one trading methodology and strategy, but how can it develop over a 15-year career, and how has that changed the way that you trade? Greg, I might get you to answer this one first, and then we'll go to Gary for his opinion on the same topic.
So I started trading at a very interesting time. It was 2007, just before Lehman's Brothers news came out and the crash in 2008. And I was working for a company trading interest rate futures. So they had a set strategy that they wanted us to apply, and it was more of a hedging strategy, very much, dealing with pips back then. And the idea was to hedge positions out and sort of take a few pips here and there with a rather large size. So that's how I learned. And after that, I moved on to the equity side briefly. And that's when, like everybody else in the trading game, I went through the different methodologies. I learned the full range, went through them all, looked for that holy grail, which obviously does not exist. And it was in 2011 pretty much when gold was heading towards its 1920 high. And there was somebody who was posting articles out with Elliott Waves calling for the top. And, at the time I was incredibly bullish. I was watching the market go higher, calls for 2000, 22, whatever it was. And, basic technical analysis was calling for higher levels. And I found it fascinating on where these views were coming from was so different to the methodology that I'd always applied. And it interested me, and I started to get heavily involved after the gold top. It was confirmed. And I spent, it's now 12 years studying Elliott Waves to its absolute finest details. Of course, I apply Fibonacci levels with that, the retracement and the expansion levels. So that for me was a big turning point when I moved on to Elliott Waves. And that for me now has certainly been my primary. Of course, I do still chart with basic technical analysis skills. I am knowledgeable in multiple forms of technical analysis, but my preference is certainly to apply it at waves to the markets.
Yeah, definitely. And how's that changed over a little while? Like these days for retail traders, I suppose just technology and the access to maybe different education streams or just generally access to the internet has forced people to adopt new ways.
Yes, so of course there's some change in the set. Markets are dynamic, they're always changing. But at the end of the day, the theory is based on sentiment. It's based on, emotions, how traders are going to act in certain situations. So even if that's programmed into black box systems, it's still essentially very fluent within the marketplace. So it hasn't changed from a wholesome level, but of course I've noticed sort of retracement levels. Certain markets where if I go back sort of 5-6 years ago, we see a lot of shallow retracement, especially in metals. And now in corrective phases, we are seeing much deeper retraces. We are seeing impulses extend a bit further. So it does seem a little bit more accelerated, but on the whole, nothing major changes to my theory or methodology.
Yeah, nice. That is actually interesting. You bring up the acceleration of trading. Gary, I imagine 35 years ago, acceleration and pace in the markets wasn't really considered, maybe. But these days, like you're just talking about fiber optic connections, like if even that is just the powerful nature of a trading. What would your impressions be about changes in the markets?
Absolutely. First up, there are an amazing amount of similarities in the techniques that both Greg and myself use. My upbringing in terms of trading was a little different. I started in 1983. I was classically trained in Western technical indicators and a fundamental approach. To this day, I am a hybrid trader, and I started being mentored by a gentleman named John Bollinger, of course, of Bollinger Bands. He was working as the technical manager at a very, very small TV station, which was bought out by FNN, which became CNBC years later. And what happened was I used stochastics, moving averages, and almost all technical indicators that are Western based. But in approximately 1990, when candlesticks first came out, I was introduced in an odd way. And that was I had a client, and it was a non-discretionary account, and I saw him hit 10 out of 10 trades. Not only did he hit 10 out of 10, but he also sold the absolute tops and bought the bottoms. And I emailed him and I said, "What? Do you have a crystal ball? Is there a witch living next door? How do you hit 10 out of 10 and hit these tops and bottoms?" He said, "Gary, I couldn't explain it to you if I wanted to, but I'm going to send you a book." And he sent me a book by Seiko Shimizu, The Japanese Chart of Charts, which totally transformed my life. It took me about 2 reads to get a sense of it. It took me till about 80 or about 92 to really get a strong feel for it. But I realized that the Japanese had a way of looking at the market through a type of chart that uses the same information as a bar chart, open, low, high, and close, but by putting a body around the relationship with the open and close, and coloring it in green or white if the close is higher, coloring it in red or black if it goes lower, was a transformative way for me to look at the market. And as I started to use that in 1993, we actually developed a software application, the Candlestick Forecaster, and it went worldwide, and it was the first software application to actually recognize candlesticks on a computer. Nowadays, any platform has got some sort of library of candlestick patterns. But it also had the ability to historically backtest. And what I found is it was very hit and miss in terms of reliability. And my partner at the time, he was the coder and I was the analyst, he said, well, how come your performance is so much better than what we're getting out of this historical track record? And he goes, I just don't understand it. I told him, well, I don't always take the calls. He says, well, what do you mean you don't always take the calls? I said, well, I use other things and they kind of got to match together before I take the calls. He goes, well, what are you using? I go, well, my go-to is Fibonacci retracement and Elliott Wave. He said, well, my God, we've got to reevaluate the software, and we put in Fibonacci retracements into the actual identification engine, but it shaped my way of thinking. And that's why in 2010, I revealed the system I use. It's called the New Technical Triad. It was published in Stocks and Commodities, and it talks about developing a system using candlesticks, Elliott Wave, and Fibonacci retracement. And I've used that technique to this day.
Perfect. It's incredible. I'm gonna change gears just quickly. We're jumping into one of our topics before we start the analysis breakdowns. Government bodies they've got their hands full at the moment, full of inflationary pressures. And as I think probably most of us are very familiar, gold is perceived to be a safe haven with inflationary talks. It seems like on the charts, there's sell-offs almost every month. There seems to be dips and ups, but it seems to be kind of consolidating a little bit. I wanted just a quick couple of minutes. Is this a buying opportunity for gold? Gary, what are your impressions on where we're at with gold at the moment before we get into your charts?
Well, I think it is. Short-term and interim-term are two different things. Short-term, as I said, we bought last week at 1790. We had two other trades that we have done this year. It's only January, and that was also buying. But I try to be aware of buying and then trying to get out as close as I can, because there's peaks and valleys, so to speak. But inflation, I believe, is the number one cause where we're seeing a higher and higher correlation between the strength in gold and inflationary pressures. The first thing is the Federal Reserve here is in a quandary, and they've let inflation go out of hand. The CPI is at 7%. The PCE, which is the preferred index released by our government for inflationary pressures, is at 5.8, both at 40-year highs. Now, the key is that their only tool to deal with it is to raise interest rates. And of course, when you raise interest rates, you have another effect, and that tends to slow or contract economic growth. And so there's that push, pull, or tug of war kind of thing between it. But I believe that inflation, in terms of market sentiment, has overtaken the fears of rising interest rates because they're so high. And the other thing about inflation is, if you think back to periods of time where we've had high inflation, I don't know if it relates to Australia, but definitely in America, when we had huge inflation in the early 80s. And of course, the inflationary high comes at a point in 1982. The prior year, our interest rate was 16%. That's the highest inflation we have on history, on record. And so you've got those two kind of fighting against each other. But my point is that ratcheting interest rates, even if they raise over here our Fed funds rate by a full percentage this year, that's not going to touch inflation. They raise it by 3%. It's not going to touch inflation. It's a multi-year process to bring a 7-point level of inflation down to an acceptable target, which the Fed is saying is roughly 2%. Yeah. And so for that reason, I don't think that these moves alone, without some sort of kind of administrative help, something from the government itself, is going to combat inflation. And the second thing I want to say about inflation is, if you look at how inflation has risen through the years and then prices kind of follow up, with a few exceptions such as oil and gasoline, inflation will ratchet up costs, but when the inflationary pressures move down, the costs don't go down. In other words, the inflation might go down, but the real costs of goods and services are kind of stuck there. You don't see across the board corporations lowering prices because inflation's gone from 7% to 2%, but you do see them across the board raising prices because of the increased cost that they have for goods and services. So it's a tough question. Inflation has overtaken the concern for interest rates, and that's how I feel.
Definitely. Greg, I might throw it to you. In inflationary terms, and definitely government bodies making decisions, it's all market sentiment. I know you're a technical analysis trader. What kind of weight do you give into inflation? How much does it depict your trading these days?
Well, firstly, what Gary said there is absolutely spot on. It's just crazy to think we've got asset bubbles everywhere and we're still sitting around 0% interest rates. And just the thought of raising rates is already causing panic in the marketplace, as we saw the last couple of weeks. Gary mentioned the 80s, we had interest rates at 16%, and that was, 8%, 6%, that's normal. Now we are in a situation which we have zero rates. We've got inflation peaking its head, and any chance of raising rates, it's just not possible with the amount of debt that we have in the system right now. So yes, the Fed are attempting to, or Powell's talking a big game. I don't think he's actually going to follow through with any real hiking cycle. Sure, we can see the odd interest rates here and there, but I mean, we're sitting at zero and inflation is at 7%. It's just incredible the mess that they've made of the situation. And as Gary said, this is exactly the problem that they have, is the economy is too fragile for them to raise rates, and they have to raise rates to try and combat inflation. So whatever they do, it's not going to end well. I think that's quite simple. And you are seeing a lot of gold bugs on the back of that. Gold is sniffing something out in that regard with regards to what the actual situation is. And so, yeah, I certainly am very bullish gold for this year and going forward. In the shorter term, I do have some concerns, which I'll show with my charts on why I still think it's potential to see a little bit lower before the real rally phase takes hold. But whether we're going up directly or we're going up via a detour, I still believe the next big move in the gold market will be to the upside. Just with regards to inflation and gold, I don't think it's as simple as high inflation, high gold. We can go back in history and, we look at sort of the four big inflationary or high inflationary sort of period. We had 73 to 79, where gold was unbelievable, one of the best performers, up 30% in that period. Then we had the 80s to 84, 85, and gold actually suffered in that period. And then we had more recent, the 88 to 91 period, where gold also didn't really push higher with inflation. And then, of course, we can go to last year, where as inflation expectations were going higher, gold was quite disappointing, one of the worst performers last year, which I'm sure we'll see. So I don't think it's quite straightforward with gold and inflation. Of course, there is more of a correlation with real rates, and that inflation certainly does play a role. So I don't really look at inflation, if I'm honest, when I'm charting metals, but of course I am aware of what's going on in the marketplace. And I think the move that we're seeing, or likely to see in gold, could come off the back, if we were talking fundamentals, the fact that the Fed is absolutely trapped right now.
Very interesting. So that actually might be a fantastic segue. We might get into some chart breakdowns. Gary, I wanted to start with some of your charts. So if you wanted to share the screen, and then I'll do a little bit of an introduction to the charting question that I had.
Absolutely. I'm going to put on, this is really my short-term forecast. Cool. And it should be a compression triangle that is being viewed.
Yeah.
Great. Okay. So I've looked at the charts that Greg actually sent me out, and the difference, and either is possible. We're looking at Elliott Wave models, and in Elliott Wave models, there's a science to it, but there is an art to it, meaning there's a lot of kind of flexibility in how you present an Elliott Wave model within his defined rules. There's only 3 major rules, and they're simplistic when it comes to the nuances of Elliott Wave, which is why on my chart, for example, if it breaks below this lower support line that I've just put my mouse cursor to, then in fact that would be a model that I'd have to, it would violate this model and suggest looking for that big dip could come sooner than later would actually occur.
Gary, can I just interrupt you there? Sorry, not to interrupt you, but just to add sort of further, I think just with Elliott Waves, it's within corrective phases, we tend to see multiple potentials on how they'll play out. But when the market is trending and is in an uptrend or confident uptrend, confirmed uptrend, then it does tend to be a lot more straightforward and a lot more simple. But yes, whilst corrective phases that we're in, we do tend to see multiple potentials or how it could play out.
Well, I think one thing that we both acknowledge, and both sets of our charts show that, is for a prolonged period of time, gold is trading, exhibiting lower highs and higher lows. That's how you get a triangle. That's the compression of range. And if I go to a monthly chart, for example, then the time frame changes, which is the other thing that we do with Elliott Waves, whether you use intraday, daily, weekly, monthly, change your wave count moving up or down, because Elliott Wave is, I kind of describe it to my subscribers as a Russian doll. You can open it up and then there's another one, open it up and then there's another one. And so for that reason, depending on that time frame, but we both acknowledge this compression of range and how that will inevitably at some point break out one way or the other. If it breaks to the downside, I agree, we will see that and then we'll see it take off. Because being a hybrid trader, I still follow fundamentals very, very closely. I use those to kind of get an idea of direction. And Greg was spot on when he said that you can't really have that exact correlation between inflation and gold. It did this, but this didn't happen. Long term, though, if you go back to 1933 when, gold was at $33 an ounce. And I'm just going to use an example I've used many times in webinars. You could either get a $20 gold piece or a $20 gold certificate, which was convertible in gold. Either of those would get you a room in the plaza, which at that time was about $8 a night. You could get a steak dinner for about $1.50, buy a brand new suit and a top hat for about $10. Spend about $20 for a weekend in the plaza. For those in Australia, I'm sure everyone's aware of the top hotel in New York. And a steak dinner at $1.50, that's cheap anywhere. But now, if you come back to what we're experiencing now, what almost 80 years later, if you took that $20 gold piece and converted that to cash, it's worth about $1,820. You can still spend about $1,000 on a suit and $600 on a hotel room and maybe $25 and go to a cheaper steakhouse. but your buying power is the same. In other words, that gold piece has kept up with inflation throughout this period of time, call it roughly 100 years. But if you look at anything short term, there's noise in the market at any given moment that us technicians have to deal with. And if you move too far away in weekly charts or monthly charts, you can't trade with it. Yeah. So my go-to chart for short term is like a 240-minute or a daily, and then for longer term is weeklies. But there is a direct correlation between the cost of gold and the cost of goods and services. It tends to lag. It's not exact, but over time, you'll see that it's been brilliant, because the only two things that have remained stable and moved up with inflation over the last 100 years are real estate and land, which is not very liquid, and gold. You still have that same buying power. There's nothing else on earth that you can convert and look at, 100 years ago and now, that still has the same buying power, still has the same value. And that's why I think that over time, unless they get a handle on inflation, and I don't think they can for the points that Greg spoke about and that I spoke about, inflation's going to remain high or persistent for a while. And that will lead to higher gold prices. There's no doubt about it, but you're not going to see an exact time correlation. There's a lot of noise in the market, and that's because gold moves higher or lower based on market sentiment and not the actual fundamental, the book value, let's say, of the dollar, the book value of the Aussie, because all currencies have been defaced, devalued, and basically watered down to a point where they would not be recognizable by the standards back 80 years ago. And so in that way, I do believe that there's that high probability that we'll see gold. And I'll talk about that when we get more into our chart analysis.
Okay, nice.
All said. Total agreement.
Very nice. So, Gary, that was your short-term chart. Did you want to show your long-term chart? Did you want to break down that one? While we're on this,
figure out where I've got it put. And we go to one of Greg's charts, and I'll either make one real quick or I will.
Yeah, what do you reckon, Greg? We can jump to yours.
Yeah, I just
why don't you go to one of yours?
Share screen.
So, Gary,
I
you
gotta
might
stop.
Yeah.
Got it. We'll go to one of your charts now. I'll try to find mine. If not, I'll talk about it.
Can you see my screen?
Yes.
Yep, I can see that.
Okay, great. So I've got the gold weekly chart up at the moment, looking at the bigger picture, and without spending too much time back here, what Gary spoke about, the high in September 2011 was our top of wave 3, and then we spent the 4 years until we found a bottom in 2015 in this flat wave, and subsequently pushed on. This was just before Corona. We got that initial drop, and then we rallied up to this 5th of the 3rd, and we've subsequently spent since August last year literally just in this tight range. So clearly a corrective pattern after we've seen such a strong move higher, and that is why it's difficult when the market's gone sideways for such an extended period of time until we get confirmation that we're in this next leg higher towards 2425 level on where this may or may not bottom. So I'm going to show you what I'm looking at on the smaller time frames just to give you an idea. So to move that. So let's start with the triangles, which is Gary's card that he presented on that last chart. And I'm going to start with a triangle that's similar to his, which shows this descending triangle, and subsequently where Gary's labeled this, it's very possible I could have pushed this up here. If we are in a range breakout, it is possible, but I prefer this from a fib level to see us still within this the C wave, D wave, E wave. But I must stress that even a triangle in this situation is not actually bullish on the immediate term, because triangles are the penultimate move before we see a reversal in the market. So should we break out of this triangle to the upside, I have us up towards the 1950, 2000 level before we come all the way back to this 1500 to reset the fall. So this is my one concern with this triangle, is it'll just delay things or prolong this corrective phase in gold, but certainly very possible. One of the models that we're dealing with here. The other one is the triangle that actually takes us down directly, with this being an A wave, and now we're in a B wave triangle with the ABC in, and we sort of head a little bit lower towards the 1720 level, come back one more time, and then we see that release to that 1450, 1500 level. But again, all of these after this support are pointing higher. And I want to look at what would make me see gold as potentially breaking out to the upside in the immediate term. And we do have this count, which is an impulsive count, which confirms that the low is in. Not uncommon to see the WXY bottoming in this wave 4. And then we have the 1 and ABC with an expanded flat, and this 1-2 setup. Now, this was what I was looking at before the triangle, when we're sort of down here. But the nature of this rally that we've seen, this overlapping rally, makes it less likely, in my opinion. And we do have what we call an impulse 5 waves down off of this high that we struck in the 1854 level. So for me, that is an absolute key level. If we can overcome that, then I will give a lot of credit to this count and think we can go directly towards the 2,200 level. And I must say, the trade that we took in our room, we were along in the 1700 and along the 1750-ish level. And I maintained, and I'll show you on the shorter term charts, in fact, I've got it here, I maintained when we're on that level, that 1840 to 1880 is going to be a massive inflection point for me. And that's where I'm looking to hedge my portfolio. And you can see we reached as high as 1854 and then we got that 5 waves down, which is what I'm referring to, and I'll come back to that chart. So my concern is, well, for me, the major level is this 1850 at 4 level. If gold can overcome that, then I'm on board for a direct move higher. But whilst we remain below that, I've got to acknowledge that we do have a setup for lower on the micro side. And one of them is the triangle, which I showed, either breaks to the downside, or if we do break up, immediately from here without going to that 1720-ish level first, I'm going to be following this impulsive count and believe we're on our way straight directly to the 2-3 level. But if we do head back down towards that triangle, then it's going to look more like a corrective move lower. Lastly, not my expectation, but we can make an argument for a 1-2-1-2 downside setup in gold directly to this level. But again, this is all shorter term permutations. All these potential, if we get one more leg lower, still in my opinion, point to much higher levels in gold afterwards. And lastly, I want to just look at the potential, again, very unlikely in my opinion, that we get a much deeper retrace. And this would actually be more bullish for gold. If we come all the way back down to this 1300, 1350 level, and we start to rally from here, well, my targets for gold will be above $4,000, even $5,000 on the next leg higher. So this would actually, although it's a deeper retrace, be more bullish, but it's not my expectation. So why am I concerned about gold on the micro? My concern is this rally. Okay, I wanted this to be a 1-2 and to see an impulse here and a breakout, but this is very overlapping and looks very much like an ABC. And that is a corrective move followed by what we have from our resistance. Again, this resistance was marked out in the low 1700 levels. We failed at that exact resistance level and put in 5 waves down. So for me, it's very simple. As long as we're below here, I've got to acknowledge at least a move to 1700, 1720 in that triangle count. If we break above this level, then I by all means can get on board with that impulsive count and immediate break to the upside. So very, very important level around the 1854 for me.
Yeah, it seems like it's either consolidating at 1800 or it could be going down. But what do you think? Is it a no buy at the moment or wait for?
Go back to this weekly chart. Let's just look at this weekly chart. What do we have? We've got a very strong move off the lows 2015 and all the way up, to this 2080 level that we hit. And all we've done is go totally sideways, whilst the techs have reset themselves completely and now look to be attempting to cross it and to push higher. There is nothing bearish that I can see within this chart.
Yeah.
So what I'm saying is from a technical perspective, the low is either in and we're going to break higher, or in my opinion, we see one more leg to the downside before breaking higher. Again, where am I wrong in my thesis? Well, if we do start to retrace deeper, my theory is we're in a 1-2 setup for much higher levels as opposed to, hitting here, coming back here, and then going higher. It means that this was already the top, and this retrace is setting us up for much higher levels. So where am I wrong, or where I believe that gold bull market is over and we're in trouble and this is the end of the gold run? If we break below this wave 4, then my thesis is validated and I can confirm that from my side we'll have a top in place. But whilst this is holding, I don't see any reason or any concern in the long-term picture of this chart right now.
Nice. Okay. Parking the brakes on gold for a little while and see what happens. Gary, how did you go with your long-term?
Yeah, I've got my long-term projection on. Do you want me to share that?
Yeah, if you can, it should let you just jump straight in with the screen share.
Sure. Absolutely. Let me know when the chart is up.
Yep, I can see that now.
Okay. So what I'm looking at right now is this is the compression triangle I had put in on our weekly chart. And what I believe is my longer term count, and this is not a super cycle, but it's what I call a major. Elliott Wave goes super cycle, and then it goes intermediate. But 1168, and that occurred back in the mid of 2018. Gold's at 1168 is a conclusion of a wave 2. That started our wave 3, which started at 1170 and concluded at the top of the market, which was about 2088. and that of course occurred back in August 2020. I believe that we concluded our fourth wave down, and that's where Greg and I have a difference of opinion. He's not convinced that the data supports it. I agree with that, but I believe that it has concluded. I could be wrong. I'll believe I'm wrong if it violates this support line here. However, I believe long term, we could get something like a 1 here, and if we get that breakout, we will go to higher pricing. And the first challenge is going to be 1920, and then 1850 comes in before that. We'll probably get some sort of decline at that point. But long term, over the next year and a half, by simple tools, I'm using a Fibonacci extension. And the Elliott Wave rule of thumb is if you take wave 3 and you do an extension of 0.618% at the conclusion of wave 4, that should give you a rough idea of where gold's headed over the next year and a half. And my forecast is over $2,200 within a 1.5 year period. And that, of course, is going to have peaks and valleys. But will it go to 1720? It certainly could. My critical area is 1780, 1770, because that's where my support line matches up. So if it breaks that, then I have to look at other couple of models that I have. But this is the primary model I'm using with our long-term prediction.
Very nice. It's interesting to see where that all goes. So that's pretty much it, really. Where, like, I've got one more question, like, to pose to both of you guys. It doesn't really involve the screen sharing, but how are you for time, Gary? We're at almost 45 minutes. Greg, how are you guys for time?
I'm okay.
I'm fine.
I might ask one more question just to kind of get us to the 50-minute mark, and we'll see how it goes. But the main question that I wanted to ask, what is it about gold in 2022? We're seeing a lot of fluctuations with other markets. The stock and the crypto market seems to have been taking a hit and very volatile, especially if you're looking at Bitcoin charts. Gold's seen a bit of a consolidation, but it's generally pretty good. Is there anything different about gold compared to these other assets in 2022? Gary, I might throw that to you first.
Certainly. Gold is pegged against the US dollar. And therefore, the most sensitive aspect of moves in gold have to be dollar strength or weakness.
Okay.
Inflation is one thing, but it's directly paired. So when we saw dollar strength, it was basically because market sentiment towards interest rates going higher started getting ratcheted up. The dollar had strength. The dollar's come down, which is the recent rally that we're witnessing now. That's, to me, the largest influencer to gold pricing.
Very nice. Greg, what's your opinion? What is it about gold that's keeps sticking around?
Again, and I actually found it quite funny when Gary's told the story about the plaza and the stake. When I learned about metals in 2009, 10, that's the exact story I got told. That the purchasing power, it was more from the Roman time, but buying the pair of shoes and the pair of shoes back then, the whole essentially your money carries weight. So what I love, what I find fascinating is how in this new world that we live in, everybody, or the newer generation, should I say, are writing off gold by calling Bitcoin the new generation, that gold's finished, that there's no place for gold anymore, it's opaque, which is just not true. I'm all for Bitcoin and the crypto market. I spend a lot of time trading that, but there's always a place for gold. And, it doesn't matter what role, whether it's, historically a safe haven role, which I totally disagree with gold being safe haven, but anyway, it's people bought it for that as a portion, as a diversification, as a hedge against inflation. Again, not my line of thinking, but that is why people do buy it or have bought it in the past. And as a protection, gold is in essence something that's lasted through time, which no other asset can say. All the years back that gold survived, gold's when it's been caught dead over and over again, is still here and still very much fundamental to our system, especially if you look at fiat currencies, which are absolutely worthless right now. So there's always going to be a role for gold, in my opinion. And what's the difference in 22? Again, we'll be talking why gold should be dead in 10 years time, 20 years time, 30 years time, yet it'll still be there.
Fantastic. I guess gold will definitely outlive all of us. We'll see. Anyway,
Currency for sure.
Definitely. Thank you for jumping on this interview. It was great to see a bit of a gold breakdown from both of you gentlemen. Gary, thanks for transmitting straight from Honolulu, Hawaii. It's interesting to see it all from international correspondence level at this stage.
Oh, you're very welcome. It was a pleasure.
Fantastic.
Thank you, Doc. It's a pleasure. Gary, always a pleasure to speak to you. Thank you.
No worries. Definitely for Gary, we can check your work out at goldforecast.com. Still the best way to keep up to date?
Absolutely. The Gold Forecast, one word.com. We have The Gold Forecast on YouTube. And my Twitter handle is Gary S. Wagner. So at Gary S. Wagner.
Excellent. Nice. Well, we'll be sure to keep up to date with it. The either daily or monthly videos are excellent. That's coming out on your YouTube channel. Definitely underrated. So we appreciate the kind of content that you're posting out there. It's fantastic.
Thank you.
Excellent. All right. Well, thank you very much. We'll leave links to Greg's details as well. Of course, you can jump on Greg's mentor room through globalprime.com, and we'll be leaving links for all of these places in the bio for this video. Thank you again for watching, and hopefully see you guys coming back.
Thank you very much.
Excellent. Thank you.